here to talk about a special book. This is a book that has lots of pictures, lots of profiles, lots of wisdom in it. And you just wish, that, when you're reading this book, that you didn't have to, pay as much as the sticker tag, because it's prohibitively expensive. But part of the reason is it's also a fantastic book. It's a great book, and we have the author of that book here with us today. Willian Green has been writing about investing and other topics for over 2 decades now. And as you read the words in the book, The Great Minds of Investing, you realize that he has tried to talk about the wisdom of great investors, but not restricted it to investing alone. He's taken it beyond that, and he's put it together in a very, very authentic voice. I'm very honored and very happy that he's decided to come here in person and talk to us about his thoughts. So without any further ado, ladies and gentlemen, please join me in welcoming Willian Green.
Thank you so much. I'm delighted to be here, and I'm so grateful to you all for taking time off during your lunch break to come here. And I'm actually particularly happy to be here because I'm actually a shareholder in Google, or now Alphabet. And it's pretty much the only investment that I've had over the last year or so that's done really well. So keep it up. My retirement is in your hands. But I feel happy because I've rarely been in a room where there are so many IQ points. So thank you for all of your ingenuity and hard work. When I was 15 years old, I became obsessed with gambling, and specifically actually with horse racing. And at the time I was at this very posh English school, a school called Eton College that had been founded, I think, in 1440 by Henry VI, I think. And this is a school where people like, Prince William and Prince Harry went, and the current British Prime Minister, David Cameron. So I was supposed to be becoming this posh English gentleman, and instead I would go off to gamble in this turf account at this betting shop in Windsor, the neighboring town next to Eton College. And I had this illicit account because I was only, I guess, 15, so I had an account under a fake name, which was Mike Smith, not a very creative name. And at first I did pretty well, and I made some money totally randomly. It wasn't because I knew what I was doing, although I think at the time I thought I did. And then after a while, I sort of started to lose. And I realized, basically the reason I had started in the first place, it wasn't because I loved horses, it wasn't because I thought this is an incredibly beautiful sport or anything. I liked the idea that here was something where you could make money just by using your mind. And I was kind of lazy, and I thought, well, I don't want to mow lawns or anything. And here, if I can just sort of invest a little bit of money on a horse race and make some money, that's fantastic. And when I started to lose, I just thought, I'm going to stop cold turkey. And literally, I stopped at the age of 16, and I haven't had a bet on a horse race. I haven't been to a casino and gambled in more than 30 years, because it's a mug's game. You're just losing. You're just doomed to lose. The odds, unless you're particularly brilliant at sort of figuring out odds, you're just kind of doomed to lose. And so I stopped completely. And then when I got to my 20s, I discovered the stock market, and then I thought, wow, now this is what I was really after. This is the real game. Because again, this is somewhere where if you're smart, you can use your brain just to make money without really getting your hands dirty in any way. And I just thought this was magnificent. Now, I was very fortunate in thanks. That was a very good move. That was impressive. I want to see that again if you could do that. And then I was very fortunate in that I was writing for these magazines back then, like Forbes and Money, and later for Fortune and Time. And so I got to interview all sorts of famous investors. So I would, for example, I would get to interview Peter Lynch or Jeff Vinnick, who was managing the biggest mutual fund in the world when he was in his early 30s, or Seth Klarman, or Marty Whitman, Bill Ruane, who ran the Sequoia Fund for many years. So these extraordinary investors, and I would go off to Houston, for example, and I'd meet Fayez Sarafim, who is this Egyptian multi-billionaire known as the Sphinx, and he has an El Greco painting, a 430-year-old El Greco painting on one wall, a de Kooning on another wall, and he's got this 5th century mosaic floor from Syria that he's imported from a Syrian church. And I became really fascinated by the fact that there was this tiny minority of people that managed to defy gravity by performing extraordinarily well for many years as investors. And I sort of figured, what if you could reverse engineer these people and figure out why it is that they win this game? How do they stack the odds so that they win as investors? What characteristics do they have in terms of temperament, in terms of principles, in terms of insights? And is there any way that I could learn to do this? Then over the last couple of years, I was working on this book, The Great Minds of Investing, where I had this opportunity to, in the end, I interviewed, I think, 22 of these guys, and wrote profiles of 22 famous investors and edited profiles of several more. And by this time, part of what happens, I think, when you hit your 40s is that you start to suffer from all sorts of existential angst. So instead of just thinking, how do I get rich by reverse engineering these people, you start to think, well, how do I live? How do I make better decisions? How do I eradicate what Charlie Munger would call standard stupidities? How do I make good decisions in the face of a very uncertain future? How do I handle adversity? How do I handle pain? How do I handle stress? How do I balance my family, who are here, so obviously not very well, my family, my work, all of these things, and so the question really became how to live. And so what I'd like to do today is to share 4 lessons that I think are really, they're very useful in terms of investing, or at least 3 of them are. And I think they will help to make you richer over the long term, but I actually think they're also very important in terms of life. And really it seems to me that the goal is to reverse engineer these people to figure out, how do I become richer, how do I become smarter and wiser, and how do I become happier? And so I think these are lessons that help you in each of these areas. And we're going to talk, I've got these 4 things up here that hopefully you can see if the technology is working. The first idea we're going to discuss is the willingness to be lonely. And what we're really talking about here is this idea that you have to take what Peter Bernstein, the market historian, once described as uncomfortably idiosyncratic positions. That if you want to outperform, you have to diverge from the crowd. You have to be willing to be lonely. And this has powerful implications both in terms of investing and other areas of life. The second idea we're going to discuss is the power of humility, which, as we'll see, is a somewhat contradictory idea. You have to have the self-confidence to go your own way, but you also have the humility to say, yeah, but what if I'm wrong? And then you have to build in safeguards in case you're wrong. The third idea, sorry for these gloomy titles. My son Henry said to me, man, that's a real downer. The third title is the ability to take pain. But what we're really talking about here is emotional resilience, which I've come to believe over many years of covering investing is really one of the absolute keys to long-term success as an investor. And what we're talking about with all of these people, we're not talking about being great as an investor over one cycle. We're trying to achieve success over many decades. And so you need this ability to take pain, because there are going to be times when you're hit. And this also obviously also relates to other aspects of life. The fourth topic, which is slightly more elevated and airy, is the key to happiness, which it strikes me that one of the things you really want to learn from these great investors is how do I not just become rich, but how do I make the money work for me so that it's not just sort of a short circuit in my life, but is actually something that enriches my life. So the fourth section is really about what you could call true prosperity. And what we're really talking about with all of these things is the ability to stack the odds in your favor so that you're kind of tilting the playing field so that the odds of having a successful life in all of these different areas is increased. So the willingness to be lonely. Back in, I'd say, the winter of 1998, I got this fantastic assignment to go interview Sir John Templeton. And as many of you know, Templeton was one of the greatest investors of the last century. At the time, he was 85 years old. If you had invested in the Templeton Growth Fund, over 38 years, he compounded at a rate of about 15% a year. As a result, your $10,000 would turn into $2 million. And in fact, his returns, that doesn't really reflect his returns, because he was an extraordinary investor really for about 60 or so years. So he defines this ability to have great success over a long period. Now, Templeton lived in this in this gated community called Lyford Key in the Bahamas, which was a fascinating place. He had decided early in his life he was going to save. He saved half of the money that he made early in his career, and then decided with his wife, we're going to be able to live anywhere we want in the world. And so they took a bunch of pieces of paper, figured out that Lyford Key was the place. Lyford Key is a place where people like Prince Rainier of Monaco lived. The Aga Khan had a house there. Sean Connery had a house there. I think part of Thunderball, the Bond movie, was filmed there. So this was a pretty sweet gig to go in the middle of winter to go interview Templeton, this great guru in Lyford Key. And I remember as I came up to his house, there's actually, as you walked along the porch of his house, an electronic dog starts barking. And I had this quandary whether I should out him in this article as having this fake security, which of course I did mention in the article. So Templeton is kind of this giant at this period, right? This 85-year-old who was really the pioneer of international investing. He was the first great fund manager in America to venture abroad and say, why should I just be looking for bargains in the US? So the most memorable experience, strangely, with Templeton was not, in fact, anything that he said. It was watching him one morning when he was exercising, and he didn't actually know that I was there. So I'm on the beach in Lyford Key. This is a very tough assignment. And I hide behind a palm tree because I'm worried that he's going to see that I'm there. And he's in the water. He would do this for 45 minutes every day for many years. And he's in the water up to here, and he's pumping his arms and his legs like this. And he just looks ridiculous. He's wearing this hat with this crazy visor sticking out there and these ear flaps down here, and his face is slathered with sun cream, which he hasn't bothered to rub in. And as I'm watching this, I'm just thinking, this is kind of this extraordinary side. I thought I was going to see this kind of heroic sort of wise sage, and in fact, he just kind of looks like an idiot. And when I got home to New York, I'm thinking about this, and I'm thinking, actually, this is the key to Templeton. What I realized Templeton really embodies is this willingness to be lonely, this willingness to say, this is how I do things, this is a way to act that actually makes sense to me, there's a really efficient exercise. I don't care what anybody thinks of me. And it's an extraordinarily powerful way to think. And this became kind of a metaphor for me when I started thinking about the great investors. That what all of these guys have in common is they're kind of mavericks and free thinkers. They don't go with the crowd. You know, if you want to outperform, you have to be different. And this is something that all of these guys have. And you see this very vividly with this extraordinary investment that Templeton made in 1939. So the world is kind of coming to an end, right? I mean, it's really this calamitous event where Germany is about to overrun Paris. The market is still, many companies have been just smashed by the Great Depression. And Templeton looks at the Wall Street Journal, and he tells me he figures out that there are 104 stocks trading on the New York Stock Exchange that are all trading at less than $1 a piece. And he figures that actually the world is not coming apart. It's not going to end in the way, this is one of the great lines from Howard Marks. Howard Marks said to me, most of the time the world doesn't end. And this is something that Templeton figured out. So he figures that actually the war is going to jumpstart all of these tiny companies that are still recovering from the Great Depression. And so he puts in this order for 104 of these stocks, and the broker that he calls him back and says, yeah, it's an eccentric order, but fine, we'll do it. But there are 37 of these companies that are bankrupt. And Templeton says, yeah, I want those too. And so he buys these 104 stocks, and he said to me that 5 years later, when he liquidated his position, 100 out of 104 had been profitable bets, and he quintupled his money. So think about this in context, right? This guy was about 27 years old at the time that he did this. He'd started on Wall Street maybe 2 years before. He had no money. He came from nothing. I mean, his father told him in, I think, his second year at Yale, I cannot pay $1 towards your education anymore. And here he borrowed $10,000. It was the only time he ever borrowed money to invest, he told me at least. And so he borrows what in today's money is about $170,000, I think. This is incredible guts to do this. So this is the first idea, is that you need to be willing to diverge from the crowd if you're going to succeed at this. And you have this extraordinary default option, right? If you don't want to diverge from the crowd, you can just buy an index fund, and we know you'll do just great over many years, and it may be that you do even better doing that. But if you want to outperform, you actually have to be willing to go against the crowd. So I think this is one of the areas where you can apply this great line from Charlie Munger, where Munger, as we know, says, he takes a line from algebra, where he says, invert, always invert. So think about what the crowd does. And all of the stupidity of the crowd, all of the folly of the way that most people invest, and then invert it. So we know that when it comes to investing, the crowd is emotionally very reactive, right? They make these very short-term decisions, they trade too much, they get carried away by fads, by whatever seems to be hot at that moment. They're listening to market predictions, for example, a great deal. And there was a wonderful line from Marty Whitman, who said that market prediction is the last refuge of the incompetent. We know that market prediction really doesn't work. We know that you're not going to be able to figure out when the market's going up, when interest rates are going up. And yet so many people spend their time being yanked around emotionally and intellectually by watching the latest news on CNBC and the like. So one of the things that my friend Monish Pabrai, who's one of the most brilliant minds in this book, The Great Minds of Investing, said to me is that when he started to invest in 1994 and he started basically to reverse engineer Buffett, he said you could see that Buffett basically lays out the laws of investing. You can see what you need to do. And he said he would look around and no mutual fund managers and no hedge fund managers were doing this. And he said, he was like, what a country. He said, it's like an entire generation of physicists saying that gravity doesn't exist. So this became his great opportunity, was to say, all right, if no one else is going to do it, he's like, if no one else will do it, the Indian guy will do it. So he figured out that he was just going to use Buffett's laws of investing. So things like buying stocks at a great discount to their intrinsic value. As he put it at one point to me, he said, rule number one, extreme patience. So if everyone else is being very short term, exercise extreme patience. Regard the market as your servant, as something that you can use rather than as your master. So Francis Chu, another of the great investors in this book, said to me, most of the time you just shouldn't be buying anything. He said, I could wait 10 years now without buying a single stock. He's like, I don't need to do anything. I can just sit around and read until there's a great opportunity. So I think one of the things that you see with these great investors is this ability to detach themselves from the stupidity of the crowd and to think for themselves. And I think the first point to remember really is to ask yourself, do I actually have what it takes temperamentally and intellectually to go my own direction, to defy conventional wisdom? And if I don't, it's a perfectly smart thing to buy an index fund. But if I do, then these are the kind of rules that are going to really help me. I want to diverge from the crowd. And I think there's no shame in saying, yeah, this is a game I shouldn't play. I mean, it may be that the single smartest thing I did in my youth was to decide, I'm going to lose if I bet on horses and if I gamble, and I'm just not going to play that game anymore. So I think self-awareness is probably an important starting point. The second idea is the power of humility. Now, this photograph, which is taken by my friend Michael O'Brien, who took the extraordinary photographs of this book, The Great Minds of Investing, is of Howard Marks. And as I mentioned in my profile of Howard, when you're in the presence of Howard, you feel like you're in the presence of a very superior machine. He's one of those people who you just feel, man, this guy's so much smarter than I am. And he really is at some level one of the greatest of the great minds of investing. This is a guy, he's overseeing, I think, $97 billion in assets at this point. He has this extraordinary reputation where Buffett would say, when something arrives in the mail written by Howard Marks, it's the first thing I read. I drop everything and I read that. He's worth a couple of $1 billion already. He bought an apartment in Manhattan for, I think, $52.5 million. So he's a very remarkable success story. and sort of a triumph of intellect and rationality. Yet one of the things Howard said to me when I met him in his office, he has this beautiful corner office on sort of the 43rd floor of a Manhattan skyscraper. He said, the screwiest thing you can do is to think that you're a master of the universe. And this is a very important idea. He explained to me, I mean, A, the future is extremely uncertain, so you don't want to get carried away by this hubris of thinking that you know what the future holds. So he said the only constant is impermanence. We just don't know what's going to happen, and so you have to be constantly looking at where we are in the cycle and thinking, you know, am I getting carried away? Am I taking too much risk given where we are in the cycle? Rather than just thinking, you know, I know what the future is going to bring. Just keep a careful gauge on the weather and think, like, am I getting carried away? And that people do. The other thing that I would say about Howard Marks is he has this belief that comes from Japanese philosophy, from this idea of the turning of the wheel of the law, which is this Japanese word mujo, where he basically says, you know, we're all just little cogs, and the world is going to keep on, the universe is going to keep on going without us, and so you can't get carried away by the sense of your own brilliance. And he's fascinated by this idea of randomness and luck in his own life. So he said to me, actually, even something as simple as the fact that he became a very successful investor was a series of total flukes. So he told me this wonderful story where he said that he got this job he applied for this job out of college at Lehman Brothers. And the partner at Lehman Brothers, who's supposed to call him and say, Howard, we're super excited to hire you, got drunk and had a hangover and totally failed to call him. So one of the reasons why he took this path where he ends up, you know, as a expert on junk bonds and the like, is just because he didn't go to Lehman Brothers, because the guy got drunk. And so he said, you know, before you start thinking you're a master of the universe, think about how many lucky breaks came that you know, you thought made you incredibly successful, but actually were just, you know, this beautiful randomness or these deep patterns, however you want to see it, that put you where you are. The other person I would talk about in discussing this idea of the power of humility is Bill Miller, who's a very remarkable mind in the same sort of way as Howard Marks. He has this wonderful kind of Renaissance mind. I had this wonderful assignment back in, I guess, 2001 to go write a profile of Miller. And so I spent something like 45 hours interviewing Miller, and since then I've spent a lot more time interviewing him. And we had, it was this extraordinary experience because I flew with him on his private plane from Baltimore to his alma mater where he was giving a speech. And Miller said to me the only reason he had this plane really was because he had a 90-pound dog. And he really, really wanted to be able to travel with his dog wherever he went. Well, it didn't come on this particular trip. And he quoted Buffett saying that at a certain point, the scarce resource is time, not money. So we go on his private plane to, I think it was William and Mary was his college. And at the time, the market was just imploding. I mean, this is right after 9/11, and I think the market had its single worst week since 1929, and stocks are just crashing. And Miller is just buying like crazy. He's totally happy, totally calm, totally at peace as this brilliant contrarian investor, very unemotional. And he at the time he has like a 15% stake in Amazon, which has just crashed from $90 a share to $5.50 a share. And I went to some conference where, you know, Bruce Greenwald, who's brilliant mind, who's one of the great gurus on value investing, basically pillories Bill Miller for thinking that Amazon's going to survive. And Bill stands up and he gives this sort of impassioned speech, speaking sort of triple speed because he's nervous, and says, you know, if I'm wrong, I'm going to lose 100% of my money. But if I'm right, I'm going to make 50 times my money. And when I looked last week, actually, the stock is up 100-fold from then. And so he was this consummate contrarian value investor, very, very brilliant, able to see what other people kind of couldn't see, and able to apply this temperament, really this willingness to be lonely that we were talking about. And I'm standing next to him one morning when he calls his office in Baltimore, and he says, yeah, is there any news? And one of his colleagues says, yeah, this stock that we bought the other day, AES, has they've missed their earnings massively, and the stock has halved. And so it's not even lunchtime, and Miller's just lost $50 million on this one stock. And he's just totally calm. And he's like, let me see where my cash position is. Let's double our bet on this. And he's just assuming that basically most people overreact to bad news. The crowd is going to overreact to bad news. It's going to be discounted more than it should be, and his default position is that he should be adding to his bet. And so I'm watching this guy, and I kind of start to hero worship this guy, because he just embodies everything that I admire in an investor. So then you wind forward a few years to the financial crisis, to 2008, 2009, and all of these stocks are imploding once again. Financial stocks are getting killed, housing stocks are getting killed. Miller, as always, is tremendously contrarian, and he's buying things like Countrywide Financial, Merrill Lynch, AIG, and everything he touches turns to dust. It's unbelievable to see someone this smart look so foolish, and he's just absolutely crushed. And you know, one of his funds, his flagship fund, goes down 55% in 2008. The other fund goes down 65%, his smaller fund. And this, to me, was an extraordinarily powerful reminder of why you need to be humble. That you need always to remember, you know, what if I'm wrong? You know, what if this hedge fund manager that I admire, that I have my life savings with, turns out to be a charlatan or a fraudster? What if this brokerage account that I have turns out actually to be, you know, a house of cards, and the bank goes under? What if, you know, what if this private company that I've invested in turns out to be terrible? And in fact, this is a particularly resonant issue for me, because the single stupidest investment I ever made was in a private company that I'd made about 12, 13 years ago, where, you know, everything looked fantastic here. The technology was fantastic. It was run by a friend of mine who I loved dearly. He was a very talented person. And then it just goes to hell. And Goldman Sachs came in and invested at 40 times the valuation that I invested in. And so I'm thinking, wow, you know, I'm so smart. And in fact, you discover, no, you're not smart at all. You're an absolute idiot. And so I think this is a very useful reminder. And for me, part of the reminder is that you also need to be humble about your own flaws and foibles as an investor. And so for me, I think part of the attraction of investing in a company like that was feeling like, wow, I'm part of the smart intellectual set who gets, you know, these inside opportunities that aren't available to the mere mugs out there who are just getting fleeced by Wall Street. And any time you let your ego get involved in investing, I think it's kind of a disaster. So I think the power of humility is a very important characteristic. And I'll finish this topic just by mentioning this wonderful line from Damon Runyon, who's a superb writer who would often write about gambling. And he wrote this great story, Guys and Dolls, that became the musical Guys and Dolls. And there's this character in it, Sky Masterson, who's a gambler. And Sky Masterson's dad bankrolls him to be a gambler, and gives him this advice very early in his career. And he says, son, he said, in the course of your travels, someone will come to you and they'll offer you a bet, and they will say, they'll hold up a sealed pack of cards, a sealed deck of cards, and they'll say, the Jack of Spades is going to jump out of this deck of cards and is going to squirt cider in your ear. And he says, son, do not take that bet, because sure as you are standing there, the Jack of Spades is going to jump out of that sealed deck of cards and you're going to wind up with an earful of cider. And I think this is, in some ways, humility is about avoiding that earful of cider, these situations that just, you know, you think it's impossible that they'll happen, and they do. The ability to take pain. So as I was saying before, this is about emotional resilience. So let's go back to Bill Miller. So think about what Bill Miller went through during the financial crisis. He had recently gone through a divorce, which he said to me, it was an amicable divorce, but it halved his assets. He then invests his half of the assets on margin, because he is always kind of a bit of a risk taker. He loses 80% on paper of his assets in the financial crisis, whereas he said to me his wife put all her money in bonds and did fantastically and outperformed him massively, and now has like the biggest house in Greenwich, Connecticut. And so he's done well since then, so he's recovered. But his two funds get really hammered, and assets just fly out of the window. I mean, at his peak at Legg Mason, he was overseeing $77 billion. Assets go down to 800 million. And when this happens, he has to lay off tons of people. And so he ends up laying off over 100 people. And he said to me, you know, this was the worst thing. He said, people lost their money,
investors lost their money and people lost their jobs because of me, because of mistakes that I made. And I said to him, did you blame yourself? And he said, sure as hell I blamed myself. He said, I looked around, I wanted to blame someone else. There was no one else to blame. They were my mistakes. And during this period, he told me that he put on 40 pounds. And I said to him, how come you put on 40 pounds? And dietary issues are important to me because I'm always wondering how I can ever lose weight. And so I was interested in his answer. And he said, well, I ate a lot of comfort food. I ate a lot of cheeseburgers. I ate a lot of Chinese food. I would drink red wine at night. And he said, I could have come home and just had grilled salmon and broccoli and Perrier. But he said, a man can only take so much pain. So Miller said to me at one point that if you did a brain scan of the greatest value investors, he said he's pretty convinced that you would find that the greatest value investors are actually wired differently than the rest of us, that they have, that the part of the brain that processes, say, the fear of loss or the pain of loss is actually kind of stunted in them. And I think you can see this in people like Buffett, that there is extremely unemotional. You see it in Marx as well. And yet, Miller, during this period of very tremendous intensity, gets hit badly enough that he puts on 40 pounds and it becomes this incredibly intense experience. And I think this is a powerful reminder that you really need to pay attention. If you want to be long-term successful as an investor, you need to pay attention to the need to build emotional resilience. And this is a really important point that I think particularly people forget when we're going through a good period. You tend to assume things will always be good. And you tend to overreach during these good periods. We get full of overconfidence and hubris. And I think it's really key to remember one of the things that Howard Marks says, which is that life is basically a pendulum, that our own lives are a pendulum. They swing one way from one extreme to the other, that the market is a pendulum, that market euphoria is a pendulum. And so just not to get carried away during these periods where everything is good. You don't want to overreach. You want to work on the basis that there is going to be a time where I'm going to get hit. And this isn't to be gloomy about it. It's just you want to take various safeguards, like various precautions. You don't want to overreach. Bill Ruane once said to me, you just never want to invest in margin because when the market gets hit, it's just impossible to be rational because it's such an emotionally grueling thing. So I think this sense of taking great caution during the periods where things are good is a key to setting yourself up to be able to dealing with pain. But I think also it's really important to look at where different investors get their emotional strength and to ask yourself, so where will I get my strength when things go wrong? And so it was very striking to me, for example, that Miller, when I asked him what he was reading during the financial crisis, he said basically I was reading the Stoic philosophers. So he was reading Epictetus and Seneca, because what they're talking about is as he described it to me, he said it's their general attitude to misfortune. It's that they're saying you can't necessarily control what happens to you, but you can control your attitude towards it. And this is a very, very important idea. And when I look at all of these great investors, it's very tempting to assume that there was this straight upward trajectory and their lives were always going to be a success. And it's really not true at all. These guys, all of them went through the ringer. And you look at people like Everard, Jean-Marie Everard or Donald Yackman, they went through periods in the late 90s where they looked like idiots because they refused to buy expensive stocks. They underperformed for years. Everard said to me, when you underperform massively for 3 years, he said the first year your shareholders are upset, the second year they're furious, and the third year they're gone. And he said at a certain point you start to say, am I an idiot? How come I don't get it? How come everyone else gets it? So while we're talking about the willingness to be lonely, the willingness to go your own direction, it's important to understand that this requires a degree of strength. It requires emotional fortitude. But I would say, for all of you, you're going to find that in the course of a lifetime, there are periods that are very intense, and you need to figure out, where am I going to get my emotional strength? And it doesn't necessarily matter whether it's from Stoic philosophy, whether it's from spirituality, which it was for someone like Don Yackman, who was actually He was an archbishop in the Mormon church at one point, and he said to me that a period like the late 90s, he said if it hadn't been for his faith, his family, he's been married for I think 50 years and has 7 kids and 25 grandkids. If it hadn't been for his faith, his family, and the fact that he volunteered in things like the Scouts, he said a period like that could have destroyed me. And this was his language. He was like, it could have destroyed me. And so I think, this is a very important idea, like where am I going to get my emotional strength, and not to underestimate the importance of that. And also just not to idealize these great successful people and assume that, everything was just fine always. It's like, no, you're going to go through periods that are very difficult. The fourth and final idea before we get to questions is I think probably the most important, which is the key to happiness. And I've spent a lot of time over the years, studying these great investors, and some of them, are multi-billionaires, and you're trying to figure out, are they happy? What does the money buy them? What makes their lives worthwhile? And I was in a very privileged position because I got to see this up close, and so I got to see when actually they were really pretty unhappy, and you could look in the eyes of certain investors, whether it's a Tom Gaynor or a John Spears or a Monish Pabrai, and you'd be like, this guy has a kind of glow to him, and why? Where does that come from? Why is this person more fulfilled than some of the other investors? And so the reason we have this photograph of Irving Kahn is that in some ways he kind of embodies this sort of deeper wisdom about what life is about. This photo of Kahn was taken when he was 108 years old. He was one of 4 siblings, all of whom lived to over 100. It's an astonishing thing. And what's even more astonishing is he smoked until he was about 50. I'm not necessarily advocating this, and ate red meat always. And so his son Tom, who worked with him for many years, was in his 70s, said to me, he stayed young because he just always studied. He just was always learning constantly. So it was sort of he had a youthful mind until the very end. So a few months, actually maybe 6-8 weeks before Irving Kahn died, I had this very strange interview with him where I was hoping to meet with him in person, and he was too sick to meet me, and I was initially very disappointed. And then his grandson, Andrew, who's an analyst in his 30s at Kahn Brothers, at his investment firm, is a really lovely bloke, takes my questions that I've written out and asks these questions to his grandfather, whom he adored, over several days, and writes out answers. And when I get these answers back, there's something sort of deeply moving about them. This is sort of the lifelong wisdom of a 108-year-old man. And so one of the key questions I said to him, when you look back on your life and you think about not just the key to a long life, an extraordinarily long life, but actually a happy life and a meaningful life, a fulfilling life, what is it? What can we learn from you? And he said, this is a very hard question to answer, and it's different for everyone. But he said, for me, family is very important. And when I asked him what made him happy, what made him look back on his 108 years with happiness and a sense of pride and fulfillment, he said the things that were important were happy, healthy family members, the fact that he'd built a company that he was proud of, that he'd created something. And the third thing he said was that he'd met people who were smarter than him, who could give him the answers. Because he said there are certain mysteries in life that you just can't solve on your own, and sometimes you have to stop and you have to ask for directions. And so when you look at the things, and I'm pretty sure that the person he was referring to above all was Ben Graham, who was a lifelong friend of his. And he was actually his teaching partner in the 1920s. So here you're looking at a guy who lives to 109, and the things that he's emphasizing, it's not, I had a Maserati. It's learning, it's family, it's health, it's wisdom. And his son and grandson said the only thing he ever truly craved, really, in terms of physical objects, was books. They would take him to a French restaurant, fancy French restaurant, and he would order chopped steak or a hamburger. He just was totally not interested in anything flashy. So I thought that was very revealing. I had a very interesting interview with John Spears from Tweedy Brown. He's an extraordinary guy, again, with a real glow in his eye, someone you feel has figured stuff out. And he was telling me about this apartment that he had bought in Florida, which cost him, I think, $5 million. And he doesn't like to have a lot of risk. He doesn't like to have a lot of stress in his life. So he paid for it in cash. And he said to me, yeah, I felt like kind of a big shot. He's like, it was the biggest apartment in the building. And I was the only one who had 2 apartments that I put together. And he said, and so he was very funny about it. He's like, yeah, so I had this sort of sense of my own importance. And then he said, when he thought about it more, what he realized was actually the importance was that his kids and his grandkids could come stay there with him, that it was big enough. And he said to me, investors are always talking about return on investment, return on assets, return on invested capital. And he said, this is a return on life. And I thought it was a very beautiful kind of poetic phrase, and it's an important way, I think, to look at your money. There's got to be a return on life, and this isn't. I'm not trying to be self-righteous about this. This isn't a moral thing. It's like it's what works. You know, Munger always says he looks at other people and figures out what works and what doesn't work, and so you're looking at these people like Kahn and Spears and Gaynor, who are very charitable, who are very philanthropic, who are very family-oriented, and they're actually happier. And I think that's a very revealing thing. So, finally, I would mention Monish Pabrai, who has spoken here before. And Monish kind of embodies this attitude. He's thought very deeply about this stuff. And Monish is a very brilliant guy, right, and a very brilliant investor. And you know, I went with him to India recently, and he was talking about how he was a lousy student as a kid, and then they did a bunch of testing on him, and they said, oh yeah, by the way, you have an IQ in the 180s. So this is an incredibly smart guy. I mean, he has a really good engine, and he's figured out how to kind of stack the odds in his favor so he wins this particular game of investing. But the thing that Monish is going to be remembered for, and he's very conscious of this, is not his hedge fund, however good the returns are. It's actually this charitable foundation that he set up, which is very extraordinary, which is called the Dakshana Foundation. And Dakshana is a Sanskrit word for gift. And I had the opportunity to go recently with Monish over Christmas to spend several days in India with him. And so I went around to look at the charity up close and to see what it did. And what Dakshana does that's very extraordinary is it takes some of the cleverest teenagers in India, but these are people from very, very poor backgrounds. Some of them are from families that are untouchables, from very poor rural areas. And he gives them 2 years of free coaching to take the exam to the Indian Institutes of Technology, which, as many of you will know, is the Indian equivalent of MIT. And this totally and utterly transforms their lives. If you get into IIT, your prospects in life and the prospects of your whole family are just transformed. And IIT has an acceptance rate of less than 2%. Dakshana graduates, 54% of them have got in so far. It's an astonishing thing. And again, it's Monish figuring out, how do I win this game? What are the things that we can do that can make our students do really well in this exam? And I had this, and so the latest count, I think 888 of these graduates had got in. And I had this wonderful experience in India where I was in Pune, where I met I met a lot of the graduates. One of them particularly stuck out, he was kind of the star of the Dakshana Foundation graduates. He had come top of all of them in the national exams. He'd come 63rd out of more than 500,000 people in this exam, and had gone to IIT Bombay, which is the hardest to get into. And then he gets this job at a great tech company, goes to work in London, and recently came, a month or so recently came to work in California. And I said to this guy, were your parents smart? And, you know, because I knew that he lived in a very, very modest home, a very modest area. And he said, yeah, my father's incredibly smart. He said he was a superb mathematician. And, you know, but he never had an opportunity to use it. And he spent his life, you know, he makes a very modest salary as a tailor. And one of the first things that this guy had done with his money after he gets this tech job is he buys a house for his parents. And so he moves them out of their very, very modest house into a new house. And as I'm thinking about this story, I'm thinking, what an amazing thing that Monish has taken his skill at playing a game, and he's totally transformed hundreds of lives in this way. And that this young guy has figured out, actually, the first thing I want to do is to transform my parents' life, not my life when I get the money. And the thing that's more amazing about this is that guy is in this room now. And it's Ashok who's here. And so the company that Ashok went to work for is actually Google. And so Ashok went to work after graduating from Dakshana, went to work for Google in London, recently came here as a software engineer in the search area for Google here in Mountain View. So you're seeing here the fact that Monish has been able to take this extraordinary skill, this extraordinary brain, this ability to stack the odds in his favor in life, and actually use it to have this tremendous impact on other people. And I don't think this is because Monish is some sort of righteous figure. I think it's you know, he's a lovely guy. He's a great guy. I love spending time with him. But I think what he's figured out is this is what works. He's like, if I'm to have a really happy and fulfilled life, it's not going to come because I have, you know, a yacht. It's actually going to come because I figured out how to help other people and how to make other people's lives more complete. And so the thought that I would leave you with is just that you should think about your dakshana. What's your gift, and how do you take your particular gift that you have? You know, you're all incredibly smart people. How do you take your abilities and figure out, what do I do with this to make a difference in other people's lives? And I think you do this not because you're necessarily Mother Teresa or Gandhi. It's because you're tilting the playing field in your direction. You're stacking the odds in your favor so that you can have a happy and successful and meaningful life. Thank you.
Thank you, William. We're open for questions.
So you talked about you suggest to diverge from the cross. I think the people follow the cross for reasons because it's safer, it's less risky. So what's your take on this point? If you want to be noni, take more to be diverse, but probably be more risky.
So how to think through this idea of how diversified you should be to control risk?
Yeah, versus taking a risk, right? This is like a trade-off there.
Yeah, I think you've focused on really one of the most important questions. And one of the things that was fascinating to me in terms of interviewing an array of these different great investors was actually to see the difference in the way that they had solved this question. So Monish, for example, had most of his money in about 5 stocks and had tremendous confidence, tremendous knowledge of these stocks. But then one of them blew up. And you know, so it's risky. You know, I mean, there's I think it's one reason why Monish will outperform massively over the years, but I think it can be like that. And so for Monish, because he has this extraordinary temperament, it's feasible. So I said to Monish about the financial crisis, I said, how did you deal with the stress of the financial crisis? Because at one point his hedge fund was massively down. And he said, oh, I don't feel stress. And I actually don't think that's true. I think it may have been true then, but I think there are circumstances where even for Monish or even for like Bill Miller, these guys who are very unemotional, you can get to a situation where a sufficient number of things go wrong that actually it becomes very painful. And so I think even for people like Monish, who have an extraordinary temperament, you have to be aware of the dangers of overconfidence. And I talked to people like Joel Greenblatt about this, and Joel had 80%. Joel is one of the greatest hedge fund managers of all time, and Joel had 80% of his money in 6 to 8 stocks for much of his career, and he said, you know, every few weeks the portfolio might go down, 30% in a couple of weeks. And he said it was fine for him. He could cope with it. But he said he actually returned a lot of the shareholders' money. After 5 years, he returned half the money. And after 10 years, he returned all of the money. So the only shareholders were him and his family and his partners. And he said if the family lost money or friends lost money, he would help them out. And so it was okay. So I think the point is, you kind of have to look at your own temperament and say, how unemotional am I? And one of the things my friend Guy Spear was saying to me recently is you can actually get to a point where you're emotionally flooded, where you can actually reach a point where a sufficient number of things go wrong at the same time that it's very hard to be rational, to make rational decisions. And his view is that you want to try always to be the last man standing. And he said you look at Buffett, who has 10 times more capital in his insurance business than anyone else. He's basically set it up so he's anti-fragile, so he'll survive whatever goes wrong. And so Guy's view is you want to kind of look at what everyone else is doing, what the people you do what the people you really admire, where they are on the risk curve. And then he said, just do less than them. And I think it's a really interesting idea that you kind of, yeah, if you're super concentrated, if you're incredibly smart, you can get unbelievable returns. But I think for most of us, if you want to survive over not one cycle, but 20, 30, 40, 50 years as an investor, I think diversification and just saying, what do I know? What if it goes wrong? What if I'm wrong? There's a French investor I interviewed, a guy called François-Marie Wojcik, who said to me, I have 3 principles: doubt, doubt, and doubt. And I think it's kind of helpful to doubt yourself, and I think diversification, it's just kind of rational to say, yeah, but if this company I own, if I'm wrong, what are the consequences? And one of the things Irving Kahn said to me that I thought was really interesting. He said the single most important piece of financial advice I can share is to focus on the downside. And he said, the trouble these days, he said, people can gallop really fast, but he said they don't really know what direction they're galloping in. And he said, if you really focus on the downside, and he said you have reasonable returns and you avoid terrible losses, he said you'll outperform all of your gambler friends. And he said it's also a good cure for your sleeping problems.
I think you have interviewed Bill Ackman for your book.
Yeah.
Would you please tell us something about him, and do you think he will survive?
Yeah, I do think he'll survive. I think Ackman is remarkably smart. I think he's a very brilliant analyst. He's got a very brilliant mind. I think as with all of these great investors, they're flawed. They're not perfect. They make mistakes, and his mistake with Valiant, so far it's turned out to be a really dire mistake. You could say that's a kind of bull market phenomenon of overconfidence, but he's always been taking these very contrary positions, that are very aggressive, and it's part of his character. And I think, Bill has a very interesting personality. He's very combative in certain ways, and he's prepared to go into these very difficult situations where, with something like Herbalife, where he thinks, this company is a fraud and a Ponzi scheme, I'm going to take it down. And he spent over $50 million on this campaign to bring down Herbalife. And so I think he has a very distinctive approach. And one of the things he said to me about money, he said the reason I wanted to get rich from very early on was so that I would have independence. He said it was so that I could say what I believe, so that I could act in the way that I believe is right. And so, he really embodies this idea of the willingness to be lonely, the willingness to take idiosyncratic positions. And that's going to mean there are times where he's going to look really stupid. But there were times where, where Buffett looked stupid in the late 90s, where he refused to buy any tech stocks, where Eviard looked stupid, where Don Yackman looked stupid. Eviard's assets went down from, I think, $6 billion to $2 billion during the tech bubble in the late 90s. Everyone abandoned him. He said to me that one of the senior executives at his company said, well, Jean-Marie, he's half senile anyway. And Jean-Marie said to me, I was 59. And so I think one of the things that's really striking to me is that there are always periods where these great investors look like idiots. And my money is on Ackman, just in terms of his intellect, his analytical brilliance, and he's got a kind of inner toughness to him. And I think the real lesson there are multiple lessons of the Valiant situation, but I think the hubris and the overconfidence one is important, the unknowability of the future. And Peter Lynch, I was looking through some old notes from an interview that I had with Peter Lynch the other day, and well, the interview was about 18 years ago, but I was looking at the notes the other day, and Lynch said to me, he bet on some company in 1969, where he said Ned Johnson was not yet running Fidelity, but was then running a fund there, and Lynch pitched this stock to him that was an apparel company that was great. He said they'd had the cover of Vogue 3 times, and their earnings, it was like a record year. And he said, then the movie, what was it, Bonnie and Clyde comes out. And he says, Faye Dunaway is wearing these incredible long pleated 1930s skirts. And it totally and utterly changes fashion. And he said, in the same year that this company had record earnings, the company went bankrupt. And he talked to Ned Johnson about it, and he said Ned Johnson just laughed, and he said, yes, sometimes this stuff just comes out of left field. And so I think this sort of healthy awareness of the fact that the jack of spades can actually jump out of the pack of cards and squirt cider in your ear, it's useful to retain that sense of our own fallibility.
During the times when you said these investors would look stupid, there seems to be two categories. One is category where they decided they don't want to participate in irrationality they see, like Don Yackman or Everard. And then the second one is where they seem to be confident about something, but then it eventually blows up on them. So say Bill Miller, Valiant example that you gave. In those cases where they're taking a bet where they are kind of alone, how important is it where, on one side you want to be kind of confident, but the humility is confidence doesn't go into arrogance. And in several of these cases, there was enough evidence that they could be wrong. Like, for example, there's the famous Steve Eisman and Bill Miller kind of face-off type of a thing, where Steve Eisman was this young hedge fund analyst running company. They had done all this work, that this is really a bubble. In the Valiant case, there was enough evidence before that there are all these
I think it's a really profound and important question you raise. It's this thin line between the willingness to be lonely and the arrogance where you say everybody else is wrong, I'm right, and you end up blowing yourself up. And it's a very, very interesting question. And there, I was always a huge admirer of Marty Whitman, and he was an absolutely brilliant contrarian value investor. And Whitman, once I said to him, if you were to own just one stock for the next 10 years, what would it be? And he said MBIA. And this is the company that Bill Ackman shorted. And Ackman said to me that he actually, I think he said well, I can't remember if he actually met him, but I think he told me that he contacted Marty and said to him, I want to go through this and explain to you why this is crap, why it's going to fall apart. And Marty kind of dismissed him and kind of badmouthed him in the press. And Marty's a kind of combustible guy, and he's, in the way that, he's feisty. And I talked to Marty about this afterwards, and I said, why did you mess up? And he said, he's now in his 90s, and he said at a certain point, as I became richer and older, I became lazy. And he said there were certain stocks where I should have sold. He said, I knew that I should have sold my housing stocks before the financial crisis, and I kind of didn't get around to it. And Bill Nygren said to me that, this is a full-on game. He said there are lots of people who've decided I'm going to go into semi-retirement. And he's like, no. He's like, either the switch is fully on or it's fully off. He said it's so hard at that level. And so I think, it's interesting that, all of these guys screw up. I mean, Templeton said to me, however smart you are, you're going to screw up a third of the time. And there was a wonderful moment with Bill Miller where years ago in 2001, after the financial crisis, where he's making these incredibly gutsy bets. I said to him, man, you really have to have balls to do what you do. And he said, yeah, you have to have balls, but you've also got to be right. And it was it stuck with me forever. And he said, let me show you this chart. And he shows me this chart of a fund's performance. He says, look at this. You see the steady monthly upward trajectory of this fund. And then he said, and then it just collapses. It goes down 90-something%. He said, that's long-term capital management. And he said, the thing that's really hard to tell is, am I here in my career or am I here? And so I think this idea of hubris, of just saying, yeah, I believe this is true, but what if I'm wrong? And just, this is why the idea of the margin of safety is so powerful. And so I think when you look at people like Irving Kahn, who did tremendously well for decades, it's partly they survived. They didn't blow themselves up. And so Irving would have a tremendous amount of cash often. I think at the end he had about half his money in cash. And so yeah, maybe you underperform, but you survive. And so I think that idea of just being resilient, of trying to be the last man standing rather than necessarily the smartest guy in the room, that's very powerful.
Thank you for the great talk, and can we all have a big round of applause, not only for William, but our friend Ashok. Thanks.
Thank you so much.